Today we're going to talk about the top 10 errors that tank most multifamily investors, most investors period, and most importantly, how to correct them and avoid them. I'm also stick around to number 10, which is the most important one, and I'll give you an asset that will help you avoid that mistake. All right, Tyler Devereaux here, and I've been investing in multifamily real estate for well over a decade and have taught thousands of people to do the exact same thing. But I'll tell you this, I've had many successes, but I have had many failures along the journey, mistakes that I have made, things that have caused scars on my ass. So today I'm gonna help you avoid those scars on your ass. So grab a piece of paper, a pen, whatever you do your note taking with, and sincerely make note of these things, avoid these things, and pivot the other direction. Let's go. All right, the number one mistake that I have listed is not thoroughly doing due diligence. Investors often fail to thoroughly go through due diligence. They skip steps, they justify certain things, and those things down the road, especially compounded down the road, can hurt you massively. For example, one of my first mentors reeled in my head, verify all the rental income. Remember, this property that you're acquiring, you need to verify every ounce of rental income that is on there, and you need to understand what you're inheriting. Because you're gonna inherit whatever deals that last owner made, whatever processes they have in place, you're inheriting those until you change those. You need to verify all rental income. In today's market, if you identify an owner that has 10% of their tenants that owe 2+ months of rent, that is an owner that is struggling to pay their debt service, that's their mortgage payment, which means that as an owner that has massive problems that you can be in a position to solve. But as long as you can prepare for those things, you're good. It's when those things blindside you that it caused the scars on the ass. You want to be able to prepare for them. One thing that I knew about myself going in is that I'm an ultimate optimist. So I look at things and it's like, no matter what the problem is, I can solve it, right? And I fall in love with things. But I'll tell you, the biggest mistakes that I've made as an investor is through optimism, blind optimism. You can't have blind optimism. Is beautiful, man. My life is beautiful because I'm optimistic, but my investments will be beautiful. Your investments will be beautiful because you're pessimistic. You need to go in there with a pessimistic eye, looking at, sure, what could go right, more importantly, what could go wrong, and then stick to those guns and figure out the solutions to those problems instead of being blind to the problems. So number one mistake, not thoroughly going through due diligence. Mistake number two is over leveraging. Now, leverage is beautiful. Over leverage, not so beautiful. So sometimes we can rely too heavily on debt. So for example, loan to value. Okay, say that maybe we put 10% down and we leverage the additional 90, or we put 20% down and we leverage the additional 80. Listen, leverage is beautiful, but once again, you have to realize that markets fluctuate up and down. So if you are over leveraged during a fluctuation or a market correction, well, now you can be upside down in value on that property. And when that happens, you now need to come with money to the table to either refinance, pay down the loan, and get in a position to keep that deal. The reason people get in trouble with this is because when they can come in and it's easy to access capital, it's easy to get access to debt. It means they can put less down and their cash returns will be higher, but their risk is also higher because they're over leveraged. So listen, lower returns is better than increased risk. Your rule number one is to protect investor capital. Your capital, investor capital. Rule number two is to then grow it, but you can't grow it unless you protect it. So lower returns is better than increased risk. So mistake number two, over leveraged. Mistake number three is failing to diversify. This could be diversifying across multiple markets, anywhere, whether it's Houston or it doesn't matter where it's at. If you have too much of your portfolio somewhere and something happens in that market, well, now your whole portfolio suffers instead of just one property or a fraction of it. For example, what happened in Houston, taxes increased, insurance increased, and those two things alone caused some major headaches within our portfolio. Now, a good example of not putting all of your eggs in one basket, we created a fund. And a fund is, instead of investing into one property, you can invest into a fund that invests into multiple properties. Because of that, if one of those properties suffer, for example, we had one of the properties in that Houston portfolio that I was talking about within this fund. If one of those properties suffer or underperforms, it's balanced out over the additional assets. That's massive for you because you have to expect that some of your portfolio is going to underperform. Once again, remember what I talked about earlier. Do not be overly optimistic, be pessimistic. Your portfolio will at some point underperform. So if you're diversified, that is safety and risk mitigation. Number four is underestimating the operating expenses, what it takes to actually operate the property. Many investors operators get into this, will fall into this pit. They underestimate the expenses that it's going to take to run the property. property. For example, on one of my first properties, you'll hear me say under promise, over deliver, under promise, over deliver. It's because on one of my first properties, we raised the amount of money and the capital expenditures that we thought were needed. Literally that we thought were needed. Well, you gotta understand, man, one blip, one mishap, one thing doesn't go according to plan and can impact your business plan. And that is exactly what happened on that property. One thing, and now we are riding on razor thin margins for way too long. If one more thing would have happened, we could have been in big trouble on that property. And I will tell you that even though we survived the property was profitable and investors did really, really good on that deal, it was stressful. So see, even when you win on something like that, if you're riding on razor thin margins, the stress that you have through that hold period, well, man, it's stressful. It's when I lost my hair, okay? You wanna make sure that you overestimate what you need, because best case scenario is you overestimate, you have a good, healthy budget that you can weather the storm. So one more example of this, we have with an investor what we call a debt reserve, where you can handle capital expenditures on the property and then you can get refunded or reimbursed from the lender. You contribute to an account with them all the time, but you can only reimbursed after you've paid for it. So if you run out of capital, even though you have this reserve over here, if you don't have the capital to pay for it up front, they're not gonna release the debt reserve, which means you have money over here that you can utilize, but you don't have enough money to pay and then get reimbursed, and your property suffers. Once again, mistake number 4, underestimating what it takes to run a property. Number 5 is ignoring market trends. So what worked today may not work tomorrow. And you cannot expect that what is working today will work tomorrow. I'll give you an example of this. When you're underwriting your property, let's say that it's 2021, rent gains are crazy percentages across the nation. And you're underwriting your property assuming, which is what underwriting is, you're making assumptions on the future. You're assuming that those rent gains are gonna continue. Well, that's a big mistake, man. I had a partner, an ex-partner, who was very aggressive, man, with his underwriting. He was very aggressive with his rent projections, very aggressive with his underwriting period, which means he would look at what was happening right then in today's environment, project that and expect that to happen forever. That is a recipe for disaster. And listen, side note, same thing applies to your own life. Let's say that your life right now isn't going exactly how you want it to go. What I bet happens in your life, which has happened in my life and many other people's life, is we project right then, because things are struggling right now, because your life isn't where you want it to be right now, you project that's gonna be the case forever. And if you do that, you'll stay stuck forever. Understand, you have to look at this not based on what is happening right now or not from the past to here, but look in the future, what do you want? And then literally work backwards from there. When you work backwards from there on your properties and your investments, you need to be conservative. Look at historical data. What has historically happened? What do we project to happen? Meaning, what do we project to happen on a conservative basis based on not just the now, but historical data? Listen, markets trend up, down. That is a natural process. Look at when the last upswing was, when the last downswing was, where you're at now, but historically, where you could be in the future. And then be massively conservative. Another thing with that is now you're operating the property. Once again, had a partner who was very aggressive with how he managed property managers, meaning, and it hurt us. And here's what it was, okay? When you're managing your property managers, let's say the rent gain example is a good example again, that you're expecting or you're managing them based on high rent gains. And so you're holding out on these high rent gains, but you fail to look at what's happening in the market right now and understand that those rent gains aren't realistic in the environment that you have right then. So what happens? Your occupancy starts to dip, your vacancy increases, your revenue decreases, but you're too prideful, you hang tight on that, and you will undercut yourself. You gotta look at the market, you have to understand trends, you have to flex and you have to flow and you have to find ways to be creative within the trend that you're in, but do not stay stuck given in this one frame of mind. If you do that and don't understand trends, your trend will be, well, shitty. Number 6, lack of a clear exit strategy. And this can bite you in a number of different ways. Let me give you an example, okay? Where one time that it bit me, one of the scars that I have upon my ass. We bought a property and we were very aggressive with our debt terms. We put in a 2-year bridge term. And the plan was to refinance within 2 years into long-term debt. But in order for that plan to work, literally everything had to go according to plan. Once again, too aggressive. 2 years, too aggressive. Even hindsight, even if we would have done 3 years, we would have been in a way better position. But it was 2 years. What happened right out the gate? Property management company underperforming. We had to replace property management, put us about 6 months behind on our business plan. And that 6 months behind on our business plan, well, man, put us behind on the whole thing. And then when the loan came due, so you know, when a loan comes due, you either have to pay off the loan, so do a balloon payment, refinance or sell. But if you're in an environment where refinancing doesn't make sense because property values have dipped or interest rates have increased, or you can't sell it for what you want to sell it at, you are in a rough position. And you're in a rough position now because you didn't clearly identify a solid exit strategy. And now listen, here's the key. Hope for the best, prepare for the worst. Okay, if everything goes according to plan, this could be the case. That's awesome. But what if shit doesn't go according to plan? What if something does happen? Then what will happen? Then you have to have a best case and a worst case, and it has to work in both of those. Okay, another example, we bought a bunch of properties from a gentleman in North Carolina who had built these properties, developed these properties, held on to these properties. He had never exited nor thought about an exit. So now he gets to his exit and he doesn't have anything prepared that he needs to for his exit. First, we make a lot of money when we exit a deal if we make decisions in line with maximizing that exit. He did not. He made decisions in line with that he was going to hold it forever because he didn't think through an exit, which means that exit then crept up on him. He didn't keep good books. And because if you don't keep good books on your properties, I'll just tell you this right now, out the gates, your property would be discounted 20% right out the gates. Which is what happened, which is why some of the best deals we ever bought were from that gentleman in North Carolina, because we capitalized off of his lack of an exit plan. Do not get caught with your pants down, not planning for your exit strategy. Plan to exit, plan to maximize it. Number 7 is emotional decision making. Okay, your head, your mind has to be stronger than your feelings. Your head has to be stronger than your feelings. Emotional investing is a disaster when it comes to investing. Okay, listen, an example of this. Just because you have the money to buy, just because you can buy, does not mean that you should buy. See, in 2022, we sold a big portfolio, crushed it for our investors. And then we had money that we needed to place. Instead of being super methodical on our business plan, on our buy box, on the things that we live, sleep, eat, breathe, believe in, we didn't. We got emotional because we didn't want to miss out on the opportunity, and we had money that we needed to place. We wanted to take care of investor money so we could place it for them. But in reality, the best way to place it is to place it in deals that you, once again, know that you should be buying. When you jeopardize that and you let emotions creep in, your decision making goes down. Think about the biggest mistakes you've made in your life. I bet emotion was involved. As an investor, you have to be able to remove the emotion and stick with your logic. Stick with, once again, your clear plan. And the one way that helps you do that is to set a clear plan. There's 3 things that you need to answer at a basic level. What do you buy? Why do you buy it? How do you execute? Once you develop that plan, then you stick with that plan. That's logic instead of emotion. That's logic. It will lead to returns. Do not let emotion creep in, or else you'll have scars on your ass. Number 8 is overpaying for properties. Listen, when the market is up and there's a buying frenzy, it's so easy to get caught up, well, into step number 7, the emotion of buying. See, I attended an event of Tony Robbins about a year ago. Let me tell you what I saw. He did this example, got a $100 bill. He said, how much would you pay me for this $100 bill? It's $100. The top person, I'm not shitting you, paid him for a $100 bill, paid him $10,000. $10,000 for a $100 bill. Why in the world would anybody do that? Emotion and the buying frenzy. See, these two go, step 7 and 8 go hand in hand. You cannot overpay out of emotion. When everyone's buying and the emotion is high, once again, you can overpay. And what that does, well, that puts you at massive risk because you're buying with your emotions instead of with your logic. For example, buying high, 1031 exchange. If you don't know what 1031 exchange is, this is where you cash out. If you were to cash out, you sell a property, you cash out, you pay taxes, or you can defer the taxes through a 1031 exchange. You can keep the entire amount and buy more real estate. Well, that's beautiful, but then what ends up happening is you have to go from something bigger than what you currently were. So the market's been on a bullish run and you've done a couple 1031 exchanges. What I saw happening in 2019, 2020, 2021, what were happening is investors were buying not because it made sense to buy, but because it fit the equity piece that they needed to. So they would rather overpay and bank on equity than to cash out and pay taxes. That's a recipe for disaster. Do not overpay. And if you are overpaying, make sure you understand why you're doing that, what your business plan is, does it really make sense, and what is the worst case scenario if it doesn't. Number 9 is not building a strong network. Man, a successful real estate investor has a network of people to tap into, a attorneys, lenders, operators, property management companies, brokers, all the above. Your network is massive, both your local teams, but also those within, well, doing the same thing that you're doing. Think about this, doctors go to med school, attorneys go to law school, but where do real estate investors go? And listen, yes, law school, med school, all of that is great for education. Education is critical, you need to get that kind of stuff. But what I've realized with the different attorneys and the different people that I've worked with, they tap into their network well after med school, well after law school to get, well, man, to riff with them on what's going on in the market. And it is no different in the commercial real estate space or the business space. Where do you go to network with a bunch of like-minded individuals who are doing what you're doing to help you stay informed on what you're doing and how to do it better? A network is absolutely critical, and if you're relying on your own knowledge, your own perspective, man, you will have scars on your ass and be left in the dust. Make sure that you build a solid network of people to tap into, because the learning never stops, my friend. Number 10, neglecting your asset management. Your asset management, once again, this is one way again to get scars upon your ass. Okay, my first property, I remember buying my first apartment building. It's been like all this work to find it, to source it, to get it to the closing table and buy, and then it was like, whew, oh shit, I still own this thing. See, I'd been used to flipping properties. I'd buy a property, flip it, sell it. It was quicker turn. Now I own it, and the true value is by driving the value up. So I had to kick into gear very quickly to make sure that I was asset managing that deal. This is how, my friends, you actually change your life. You actually drive the values up on your apartment buildings and change your investors' lives. It's asset management. So here's the question. Do you know the KPIs that you should be tracking on a weekly basis? And if you do know those KPIs, do you know where those KPIs should be trending and what you should do if they're not trending in that direction? If you don't know those things, I can help you with those things, okay? So listen, in the link below, you can click that thing and you can get access to my KPI tracker. We call it a Monday morning report. This is the most important asset management KPIs that you need to track, where they need to be trending, and what you need to do if they're not trending there. That, my friend, is valuable. You're welcome. You need to make sure that you protect your asset management by knowing KPIs to track. You're welcome. All right, those are the top 10 mistakes that investors make that tank, once again, new investors. But number one that I want to tell you, okay, it is better to make a mistake than to make no mistake at all. What I mean by this, if you were to see a target and you were to see a bunch of misses on that target, no bullseyes, just a bunch of misses, that's not failure. You know what failure is? Failure is a target with no misses at all, no attempts at all. It is way better, man, to make mistakes, have some scars, and grow than to make the mistakes of inaction. Have confidence in yourself. Believe in your ability. Number one, gonna make mistakes. And when you do make mistakes, believe in your ability to correct those mistakes, learn from it, become better and stronger because of it, and go. I am who I am today, not because of my successes, but because of my mistakes and my failures that I have learned from to make me stronger. Man, you are no different. So go out there, take massive action, massive calculated action, but massive action. Make sure that you keep these mistakes on hand so you can avoid these ones, and then live always with aloha. Peace.